Welcome to the High Rise Podcast, presented by Headset, the leading data and analytics company for the cannabis industry.
Welcome back to the High Rise, a laid-back, data-back conversation where we talk all things cannabis, from U.S. MSOs to Canadian LPs, products and market analysis through the lens of data. My name is Cy Scott with Headset, and I am joined, as always, by Emily Paxia of Poseidon.
Hey, everyone. Welcome to the High Rise.
And today we have a very special guest and a very special episode. We've got Andrew Carter, Director, Consumer Analyst covering cannabis at Stifel. Thanks for joining us today, Andrew.
Hey, thanks for having me. Great to be here.
Yeah, really excited. So this week we thought we would talk a little bit about Canadian LPs. It's been a while since we've really had a good deep dive, and I think there's been some notable headlines north of the border here that are really worth digging into and better understanding. And who better to help us understand that than Andrew? I mean, your coverage is fantastic on this stuff, and so I thought we'd bring you on, and you could help us make heads or tails of what's going on, and in particular with Tilray. Let's start there. Sure. This Tilray Hexo news. So there's some sort of definitive agreement that came out where Tilray is going to purchase Hexo for $56 million. Is that accurate?
No. Well, yes, it is,
No.
But they're also canceling the convertible debt. So you can kind of say it's more 200 now. To be fair, that's what grabs the headline is 19.3 or 18.3 million shares. Therefore, it's somewhere in that range. It's a lot lower now, but just given where the price is. But yes, it's that's right.
So 56 million is the headline, but it's a lot more because of the debt structure.
So that's probably a good segue into this. First off, you said we haven't talked about Canada for a while. It's probably a pretty good reason. We're almost 5 years into the market's development. It's pretty much surpassed even kind of the most bearish expectations. Ours when we first looked at this market. Some of the companies that were highly promoted years ago, and we'll talk about this in a few minutes, is Constellation Brands put $5 billion Canadian into Canopy Growth nearly 5 years ago, and today it's clear to me that they are exiting stage left, trying to get out of that investment as quietly as possible with the Canopy USA. But back to what you mentioned, Tilray buying Hexo. This goes back a little bit. Hexo, of course, was one of the original big names in Canada. They did a deal with Molson Coors. They did a beverage joint venture with Molson Coors that got them a lot of notoriety. They were very aggressive, kind of first wave, second wave, going out there, put a lot of proclamations out there about being the leader in Quebec. Wasn't really any data to validate that, but they said it nonetheless. And along the way, they were doing quite a bit. They were doing a lot of M&A. I think early 2021 is when they started to really aggressively kind of embrace the M&A agenda. They bought 48 North. They bought Zenabis. And then, yes, these are some blasts from the past here. And then in June of that year, they announced that they were going to buy Redecan. Now, what's unique about Redecan is Redecan was a private company. Redecan became the market share leader in Canada. So while there was all the other companies out there were boasting about, going to be number one, we'll have a 30% market share, Redecan just did it. They had a great product. The Reddy's pre-rolls were very well regarded. There was some smoke there as well around it. I don't want to get into that about why there potentially weren't other bidders. But Hexo announced a transaction to buy it somewhere around June 2021. It was their next one in May 2021, a little hazy on which one it was exactly, that they were buying it mostly cash, and they took on a convertible debt deal to take on it, to get the cash to do the deal plus shares. Then we find out that this convertible debt deal they did actually put Hexo towards bankruptcy because it had redemptions. The holder of the bond could ask for monthly redemptions in cash or Hexo shares, but the Hexo shares had to be a certain price. That's why later that summer when Hexo did a bought deal offering, it's like, well, wait, what's going on? And sure enough, we figured out when they got to that October earnings call and they suddenly fired the CEO, came on 2 weeks later and, we have a going concern note in our press release because we can't satisfy these redemptions. that put Hexo into an absolute tailspin. So you imagine with the equity, knowing that it's always the worst thing in the world. If you're in a bad position, you don't have much to offer the world and you need more money. That's where Hexo was. So you go back and look at some public filings around that time, and you'll see that Tilray actually was interested in buying Hexo. I hope it was just, I would think it was just exploratory, as they didn't, not sure what the value in the equity was, and I'm also not sure why you wouldn't just go to High Trail and buy the convert. Well, that's what they did. Tilray eventually turned around the next year and negotiated a deal to buy the High Trail, to buy the, I call it, that's public, to call it the convert. They call it the High Trail convert. And so then then all of a sudden Tilray is a creditor to Hexo. They also do a strategic alliance between the two companies. And they have a joint venture targeting cost savings. I think it's $50 million between the two. Tilray gets board seats, etc. That was roughly a year ago. I wrote pretty positively on it because, you get the potential upside if they do well. Redecan's a pretty strong brand. Do I think Redecan's worth what Hexo is today? I don't know. I didn't cover it. But did I think the debt piece that they were buying, the $175 million, was Redecan worth that? Yeah, probably. So comfortable with it. Then you go over the next year, and as you know, this is a growth nascent industry. Hexo's in cost cutting mode, trying to keep the lights on. That doesn't really tend too well for sales performances. I don't know if I've seen a company desperate and trying to cut costs to stay alive and also grow market share in the nascent industry. Hexo's under pressure, and I think the real impetus for doing the deal between the two was, it's kind of the old problem of, I owe you $1 million, I have a problem. I owe you $10 million, you have a problem. So you either look at Hexo today, you either look at that $175 million debt and you say, okay, we might have to foreclose on this somewhat. I'm not sure when they could actually do that. I know that there was a senior secured term, so it was basically at the top of the stack. Or you got to consider the possibility that if you let it keep going this way, there's not going to be anything to take. So I think that is the real reason for pulling the trigger on the deal. And what's so odd about this deal, because of the structure of it, Hexo was actually paying a fee to Tilray in terms of like a $7.75 million a quarter of kind of advisory fees or whatever, but it was part of the debt agreement. Tilray booked it as revenue. Hexo books it in their debt, buries it in their debt. You actually have a combination that we put our note out, and it's like, okay, this is actually dilutive to Tilray's EBITDA. So not a transaction that we're positive on. I mean, maybe there's some different reasons about why this could work, but Canadian M&A has not worked. 1 + 1 has not been 2 in a lot of cases. In fact, it's actually worked against companies in terms of the provincial operators wanting to go to multiple sources for supply. And there's really not really any real brands out there in Canada. It's still development. I mean, Tilray has good supply. It's kind of a discount brand architecture. Hexo has Redecan, but Redecan's under pressure. So it's kind of a deal that they had to do. It does cement them to try to be a leader in Canada. Their pro forma market shares, they called out by all their definitions using headset data plus provincial data plus another source out there. They think it's about 13% between the two. Like I said, they think they touted a combined market share of Aphria Tilray at 17%. When they did the deal, market share falls to 6% of the combined entity. So, not really positive on the deal in terms of making it work, with a couple of kind of quick caveats that maybe they are executing this step change in their position in the Canadian market, just as we are starting to see some signs of shakeout out there. We're seeing in the headset data less fragmentation, less new entrants, price compression. It's still there, but it's not at a pace where we're going to see a massive step down in the profit pool again. At least I don't think so. And it's going to be a much quicker integration. The Tilray Aphria integration, I mean, they had 5 months before they could even close the thing, and it was very complex. This should be quick, and it'll just get down to whether the Tilray team can come in there and quickly take Hexo and rejuvenate sales, because otherwise this acquisition doesn't make any sense.
And so as far as like a strategy and where Tilray's at, we've talked about Tilray and we've talked about their foray into alcohol in the US, with the distillery, and I think it was Colorado, and the brewery was it
Sweetwater, yeah.
Sweetwater, right. So this is like, I mean, obviously there's the Afria Tilray stuff, and now this. I mean, is Canada still just as important to them? Like what for
Yeah,
Canadian
well, it is
cannabis
now.
or
I guess it
yeah,
always has been, and then they've made now an
Hmm.
incremental bet on it. Of course, I mean, it's part of the bet here is you make it so your 175 is worth something. Well, in the math I just did as well, it's like, well, I just penalized you in your stock price with my target for, okay, you did this deal, you're taking on that plus turning that into nothing and turning it into a company. So I'm kind of taking that right down myself. But to your point, it is now because it's like, okay, now we have to turn Canada into something, and it's, you're using this capital, albeit small, to do this. It's an opportunity cost of capital versus doing another US CPG business. So yeah, it is. It is still very important to them. It is leveraging that market for global cannabis category. So, but it is a diversified CPG platform. I think that's one of the things they have going for them. I mean, the cash flow from beer, the cash flow from spirits is a really nice thing to have when the profit pool in Canada is going nothing but south.
yeah. And from a brand perspective, so Tilray has in Canada, they've got Good Supply. That's was that their leader? Like the thing that generates the most revenue, most
Yes.
likely. Um, Broken Coast, Soleil, Riff, Kanika, Chowie Wowie, which I think is an edible brand,
Yep.
and then the batch. And Hexo comes in with Ready Can, Hexo brand. Do they have any others underneath their?
Hmm.
Yeah.
Yeah. Well, just go
Original
ahead.
stashed and yeah, they have original stash and bake sale
Yeah.
as well.
So they have. I mean,
Right.
that's so it's a lot of brands under the architecture. I mean, a couple of those you mentioned are ones from the Tilray deal, Kanika. Um, let's see, Chowie Wowie. I don't. I think they. I mean, I will say this. I think the Hexo. I think they have actually their brands might be better than what a Free acquired in the Tilray brands, but that's really not saying much. I mean, the Tilray had some brands that they were paying licenses to in the U.S. for things that didn't have any brand. I never really understood that, but that's neither here nor there. But yes, I would say. But yeah, they're putting the two portfolios together. I don't. I guess I don't understand why there hasn't been more simplification between the two portfolios. Like you just mentioned, the batch, mentioned Good Supply, you mentioned Chowie Wowie, Bingo. I think still in the mix. I still see it in headset data. That's a lot. A lot of those are just discount brands. Why not have one banner?
Yeah.
Right.
And I don't know. For me, looking at what Hexo has, I'm not sure the only thing you keep. I'm not sure what you keep beyond Ready at this point.
Yeah. I mean, I'm hoping they're going to bring in a brand consultant to review their entire portfolio now so they can just streamline and have a real point of view from each brand's perspective. That's what normal CPG would do. And so I hope they would do that here since this is a CPG play without doubt. It's just so funny how this industry has evolved so quickly to where it is now. Thinking about when we first invested in a Frio when it was private and went to see the greenhouses up in Leamington, Ontario, which I joked is the Florida of Canada, and like tearing ass around the facilities with Coley, who is the original guy who was manning the greenhouses. I feel like his house was right in between all those greenhouses, but they were always like the low cost and high volume producers of mums for Lowe's, the hardware stores, and the tomatoes and everything. And so that was their deal, and we really liked that for Canada at the time, and it performed well relative to its peers for a period of time. But now that it's evolved so much, now it's a true consumer play, and especially with the exposure, to your point, Cy, to alcohol and beer in the United States.
Yeah.
Well, it'll be
The brand
interesting to see. Hmm.
totally. And I looked up some data on the brands just to kind of get a sense. I only looked at Ontario, and certainly it's not representative of the country, but given a fair amount of volume, and I had the data pretty handy. But I was looking at Ready Can, and I remember that, Andrew. I remember when Canada was coming up, and Ready Can, I feel like, and this is anecdotally, like they weren't they weren't Tilray, they weren't Aurora, they weren't Afria, this name that seemed like everyone was talking about, assuming was going to just dominate the space, and they just rocketed up the charts. in the beginning, and it's like, who's this Redican? Like, capturing all these sales. I think that lasted, for a fair amount of time, but I was just looking at their numbers, Q1 of last year versus Q1 of this year, and they've declined quite a bit just in quarter over quarter sales. It's about down 20% on Redican from where they were, basically at this time last year with sales. And you contrast that with Good Supply, which is, one of the larger brands under the Tilray umbrella there. And, that's gone up 45% in Ontario, just a quarter over quarter. And I just looked at Ontario in general, like how it has it performed quarter over quarter, and it was up 10% in our numbers. So, definitely Good Supply is outperforming the market there, and Redican's falling behind quite a bit. I obviously don't know the nuance of it, but I wonder, if some of those trends are driving some of this as well, or kind of.
Yeah, well, I mean, what you said there is
place.
that Tilray organically is gaining its footing. We're seeing that in data, back to stabilizing its market share. Had a big March overall for across their whole brand portfolio, and now they actually hired a new head about a year ago to come in there, who's now he's had a year or so, and now you're taking on Hexo and adding the challenge of, okay, now you have to stabilize this and do something with that with this. Now there's question is also, is there going to be cannibalization of the two, and how are the provinces going to look at this? But I mean, the one thing they have going for them is, they mentioned it on their call, there's literally companies out there that can't pay their provincial taxes on time, and eventually there will be a shakeout. Maybe they're doing this deal just as the shakeout's taking hold and they have this critical mass to be a supplier of choice. There's a lot of capacity out there in Canada, and it's a very difficult market overall for private operators. So it's difficult. And one other thing that we put in, that we've said is, I will say this, that Tilray's management team has one that, I don't agree with every decision they made. You can't say everything they've done is correct, but generally the underlying theme of how they execute is there's no commitment to past investments, and their investment in this market is not unconditional. And I think regulators, politicians have to consider that a company that pays its taxes, a company that provides jobs, employees, they have to consider whether this is going to be an investment worth going. And maybe it's not at this price, because I think at this price it requires Canada to work at some point and for Tilray to be a leader. But you could very easily see a scenario where they say, okay, our stock price is here, we're losing money in Canada, we're not sure if we see a path to really generating a great margin here. They could just exit. So that's one more consideration. Sorry for the long diatribe.
No. Just, I wanted to ask a quick clarifying question. When you say we need for Canada to work for this to work, what do you mean about?
What I mean by that is, okay, 13% market share, it has to translate to being a profitable business where they can at least profitably grow with the market, and then leverage that position for future markets, whether it be the global businesses. They have toeholds in other markets in medical. They obviously have the beer business, which might be able to be leveraged for cannabis, might not. Frankly, I'm agnostic to it because it generates cash, and it's a decent brand. But what I meant is for the stock is, you have to create something out of Canada and take all this infrastructure and create a profitable business to show investors the investors are interested in buying.
Thank you.
Where does Tilray sit right now as far as kind of Canada cannabis versus their other operations, as far as like the revenue and the cash flow? Is it mostly cannabis still, or are we seeing like it's actually alcohol?
It is mostly cannabis at this point in terms of like the net revenues. It's still very high. You said something interesting. Their distribution business is very large, but it's very low margin. It's their European distribution. I think what I'd say is they don't break out the profits by business, but I think if you tore in, I think Canada cannabis and just isolate medical plus adult use, I would say that is losing quite a bit, and its losses have been increasing over the past year to a point where the incremental losses from price degradation, which you get hit twice there, the price loss, plus a fixed excise tax system. I don't think it's not
Mhm.
offsetting the incremental synergies that they've taken cost, while the other businesses, and this includes alcohol, even distribution to a certain point, very low margin, as well as international medical, are the more profitable businesses there.
Yeah. Yeah. Interesting. So when this is done, assuming it gets done, where do they fit in Canadian cannabis? So they're saying they're going to be the leader at
Mhm.
13%,
Yes.
and then who's right around them up there?
Yeah, I mean, right now in terms of the cannabis leaders, there's another company called Decibel. This is per, of
Hmm.
course,
Mhm.
the headset data. Their leaders, they're kind of a leadership position. So, and then I think one I will go ahead and call out there that's very interesting that it's crept into. It's not the leader, but Kronos Group. Kronos Group has actually built a brand around its spinach portfolio, and it's actually outgrowing the market and has created a relatively sizable position there. So that one's the one that is relatively interesting as well.
Yeah, and Decibel, their brand or one of their brands is General Admission, right?
Correct.
Is that yeah.
I
Yeah, I've
like
seen
that.
them. Yeah, I know it's a great name. Yeah, they're definitely top of the charts there. Or in
Yeah, and I'd
Ontario
be
anyways.
remiss
And I
to not
was
mention a couple of the other names. Village Farms, Oxley,
Yep.
Organogram are all in the mix, and one that's kind of fallen quite a bit is Canopy Growth, and they're now. I mean, this was the company that was, you know, many thought, including me, quite a bit ago, that they'd be the leader, and right now, I have them in the headset data number 8 overall.
yeah. Well, it's a great segue because that's the other item that was in the headlines just in the last few days here was their new debt that they're taking on. And so, yeah, just curious about, how you might understand that, where that's coming from.
Sure.
Is it good or bad? I know, yeah, we talked a
Yeah,
bit about, yeah. But
yeah.
yeah, if
That's
you want to dive into that, it'd be helpful.
I mean, I'd say right now I kind of a mixed take on it. I'd argue a relatively kind of negative to expectations. They have 337 million in convertible debt that's due in June, or was due. Some of it, that portion was converted. 100 million of it is owned by Constellation Brands. Back in the fall, when Canopy USA transaction was announced, um, they said in the agreement that they would reprice that, or exchange that, with Constellation Brands for up to 100% in equity before, of course, Constellation Brands goes its Canopy equity stake. This was kind of in the Canopy USA timeline of events, something that is likely well behind schedule at this point. It was something that initially they wanted a shareholder vote in January. At this point, just given the documents we haven't seen, and given kind of the cost of doing this, I wouldn't be surprised if we didn't see the vote until the annual meeting in September. So that's a little bit of the timeline. But I'd say one side of it is they said that I think the day that Canopy USA happened, I think Canopy closed $4 Canadian per share. Well, it's $2 per Canadian share now. So it's a lot more dilutive if you want to do an exchange. But instead, they're doing it with debt, and it's just kind of adding to the pile of things versus something that could have been quickly fixed. Dilution, mind you, but at this point, I mean, as I say, is if you're not generating any free cash flow, and I'm not sure what your timeline is, pretty much any equity issuance is accretive at this point, especially for exchanging any debt. In this case, 4%. But Constellation has pushed it off to December 2024, the 100 million.
Mm-hmm.
Who knows what they'll do? It's a promissory note. They could have. They could. I'm not sure what the recourse on this is. I'm not sure that we don't just get there and Constellation has an exchangeable position in Canopy Growth, and they're not on the board anymore, and they just say, hey, forget it, just default, or hey, we'll let you come in for some massive price. It's actually what Canopy did with TerraSyn. The TerraSyn deal back in December was actually kind of smart because TerraSyn could have defaulted on that really with no consequences given what securitized that debt. So we could see that helping them out. But in my view right now, it's just one more thing that why not do that or do some kind of equity issuance now to kind of help this investment? And for me, it's one of those things that I look at it and I say, okay, Constellation is now fully accredited. I mean, they were before with convertible debt, but they're a creditor at $100 million, which is 10% of the market cap, and they also have majority board control. That seems problematic to me overall in terms of who it is. And I guess I would just, it's all been kind of looking at the saga between the two, Constellation and Canopy Growth, Canopy Constellation investor, Constellation having majority board control. I've seen a lot of comments from, I mean, first off, Constellation doesn't say much about Canopy recently, unless it's in their call, kind of the adjustments they do in accounting. The last thing I can remember them saying was something around Canopy USA solidifying our position that we will not give Canopy any more money, something along those lines. First off, I don't cover Constellation, but that was the first time I'd heard that comment. But second off, if you're invested in something that is long duration and cash flows and in a nascent industry, and if you believe in it, I would think all options are on the table in terms of supporting it or not. And I'm not sure what the advantage publicly in saying that or publicly outlining a conditional approach to the Canopy platform was when you're in that kind of position of control, of having majority board control, and you still own 35% of it. Other than, and this is as we've kind of written and noted, I think one other quiet thing about the Canopy USA deal is it facilitates a quiet divorce between the two. But again, Constellation is still on the board at Canopy Growth, and they're on there in this interim lame duck period a lot longer than they expected, given the Canopy USA transaction has taken so long.
Yeah, I mean, as an investor, I always think about what debt versus equity means, and in terms of, to your point, is it a vote of confidence? Are you looking to be in this longer? I mean, I think this has gone on longer probably than Constellation thought when they put the $4 billion in. I still remember I was speaking at a conference in Toronto with Tahira, and they announced that deal, and Bruce was speaking at the same time in an adjacent room. I think there were 4 people in my conference room. It's okay. It's fine. But I think, it's time, it's gone, time has extended on this because there has not been change in terms of opening up more access into the US market for them, which is what I think that they were trying to do with this. But them kind of extending on a debt side versus converting into equity, I think is them just giving themselves more optionality of an out potentially, but we'll see.
Yeah, I mean, I still remember that day. I remember that day well, and I remember everything in cannabis lit the sector on fire. So if you think about what kind of Constellation did back then, it's okay, you were interested in the space, so you made an investment in one thing, set everything on fire, because I'm not going to name any names, but there were things out there that were going to go out of business that were listed on the CSE that did debt offer, equity offerings, right? Shortly after that. And it was just an amazing, just absolute miscalculation of the game theory of the space and how much money flowed into the space at that point, making it that much more competitive with Constellation making this investment. I mean, one of the better things is I still remember one thing that they talked about. For instance, I think Canopy bought Ebu shortly after they got the money.
Mm-hmm.
And I think they said to us that, yeah, Constellation looked at this business first and then wanted us to do it. So Constellation looked at a business and then invested in you, let the sector completely re-rate, and then you put money into this asset. That doesn't make sense. But again, I think a lot of us got caught up in that. It's like, wow, Constellation really knows something here. Oh, they've really dug in. The diligence they must have done here. Well, no, not really.
Yeah, crazy money. $5 billion.
Yeah,
That's
5 billion Canadian, and it's 5 billion Canadian. It's 5.5 billion total in equity that they put into the thing. Or actually more than, no, it's about 5.6 actually. The initial 245, they exercised that warrant that came along with that. Another 245, that's 490, and they did exercise another portion of their convert, putting it 5.6. That's all cash, all equity, and today Canopy is in a net debt position.
well, Andrew. what's next for you on your coverage? What are you looking forward to? What's coming up when it comes to
Sure.
the cannabis sector?
I've got Pool Corp reporting on Thursday on 420, so that's kind of exciting. Swimming pools and cannabis. I think
There's the
for
crossover, right?
yeah, exactly. So I'd say for us, I continue to be very watchful of the hydroponics names. I think that it's a sector that did disproportionately capitalize profitably on the sector. We just didn't know how overbuilt it was, and the companies didn't either. And they made a lot of decisions, including financing decisions, that have kind of left them to not be immune from the troubles. But I still looking for light at the end of the tunnel, because at the end of the day, I mean, you just mentioned, hey, things can go to the illicit market. Well, hydroponics actually supports both markets. I mean, some of it's bought by the licensed channels, and some of it's bought, so you have something that will eventually go to the high single digit growth of the industry. So that's probably the next thing I'm looking forward to. It's looking for the shakeout in Canada to happen. So and then on that side, and then of course just more progress on the U.S. because brands are being developed. We see that in headset data that are out there. There'll be the opportunities for another day of who can kind of cut through all this and kind of achieve what any brand is after, a true connection with the customer that is lasting. So that's kind of what I'm on the horizon for me.
Yeah, good stuff. Well, thanks for all the insight today. I got to be honest, that stuff sometimes is beyond me. The nuance of debt structures and all the rest, I can't keep track of it. So I really appreciate you kind of cutting through what it means and making me a little smarter today. So thanks for joining. And
Absolutely. Thanks for having me.
Thanks for listening to the High Rise Podcast, presented by Headset. For more information on Headset, visit headset.io.